Ladies and gentlemen, welcome back. It's a pleasure and privilege to run the How to Save Free Markets from Inflation panel. And I have three gentlemen here, very distinguished gentlemen here with me. Sir John Redwood to my left, Charles White-Thomson, and Richard Rahn. And I will introduce them briefly before we get into details and discussing how we can solve this issue, if we can solve it at all. So Sir John Redwood has been the Conservative Member of Parliament for Workingham since 1987. He's a long-standing champion of free markets, privatization and Brexit, and Sir John ran Margaret Thatcher's policy unit before that, and before he became an MEP, an MP in 1980s. And of course, he was one of the most long-standing campaigners for Britain to leave the European Union. And furthermore, he has written extensively on monetary policy and, of course, facing the problems that central banks have across the world, but especially that the Bank of England has today. And we're very much looking forward into hearing what you have to say on that front, because I'm sure we might have some similar approaches when it comes to interest rates and when it comes to interference of politics into central banking, which should be independent. And the next gentleman who I would like to introduce is Charles White-Thomson, Royal Military Academy of Sandhurst, how do you say?
Graduate.
Graduate, yeah.
Yes.
Graduate, well, thank you. He has been in the financial industry, in the financial markets for more than 30 years. And very impressively, he has been and has run the Credit Suisse operations out of Moscow for 17 years and has especially run the risk operations for Ukraine, Kazakhstan and Russia. So he will tell us a lot about risk in this risky business of finance and banking. And furthermore, he has been in charge of distribution at various banks. He has also run a private business, a retail business in the UK for 4 years. He has been with Saxo Bank for 5 years, and right now he's with ASI, and he's the Paragonist and risk manager there. He has seen many banks go bust and has accompanied some of them that have been bought by Credit Suisse. So he knows all about this business, trust me. It will be a very nice discussion. Further, I have Dr. Richard Rahn sitting here on this panel. He's a graduate from Columbia University in the US. He has been on the Cayman Monetary Authority, Cayman Islands Monetary Authority, plus he has been the chief economist of the US Chamber of Commerce. He has been advising and with the Bush Senior administration plus the Reagan administration. Right now he is a syndicated columnist, or he has been for a very long time, and he's an entrepreneur. He is the chairman of Improbable Success Productions and the Institute for Global Economic Growth. And he runs a very nice and very interesting entity right now, the Metal Convertibility LLC, which he will tell us also a little bit more, which I assume. That is from my side. I would invite Charles to take the floor and drop it off and tell everybody in the room who does not know what risk is, yes, how a banker and financer does not sleep eventually when you have to follow the red tape of regulation.
Thank you very much. Thank you for that kind introduction. I think just as a point of refinement on that, so I looked after Credit Suisse's business in Russia, Kazakhstan and Ukraine over the financial crisis, so between 2007 and 2011, which was an absolute eye-opener. It was a masterclass in how to manage risk. And I think just one word on the ASI, which I joined on the 1st of March. The thing I particularly like about this is their independent thinking. I also particularly like the fact that they are obsessed about the next generation, as am I. And you know, I would encourage the next generation to pick up your verbal cobblestones, to make your voice heard, because you know, with a shrinking workforce with £2.6 trillion in debt, you need to make your voice heard or you will pay for this. And I say verbal cobblestones before I'm taken away for citing a riot. But on to the subject that we are here to look at, how to save free markets from inflation. I think it's a very interesting question. And what we should do is we should cast our minds back to those dark days in October 2022, where UK CPI or inflation peaked at just above 11%. UK CPI peaked above just 11%. And that was a very, very dark time for this country. And I think as we think about how we can stop this happening in the future, we need to think about how we got there. And we got there because of monetary policy failure. Basically, interest rates were too low for too long. And the area that I would like to concentrate on is between March 2020 and December 2010, where interest rates were at 10 basis points. This was rocket fuel for an already juiced up market. And that was monetary policy failure. And then you throw in the Ukraine war, you then throw in the savings from the COVID crisis, and you have this sort of perfect environment. But we should not let off those people who are in charge, because you know, if you keep interest rates for that low for that long, you will get inflation. But the trouble was that we hadn't experienced inflation for 20 to 30 years. And when I started thinking about inflation in 2020, I needed to speak to my father-in-law, because I didn't know anyone else who'd been around when inflation, who was working, had been, unless they lived in Argentina or some emerging market. I didn't know who else to speak to, so I spoke to them, and they would tell me how prices just jumped and jumped and jumped and jumped, and this was a frightening thing. And I think as a result, the MPC, they didn't have that experience either. So they were full of economists, they were full of technocrats, they had a model which told them what to do, and they did it. And that's why we had that really negative debate around whether inflation is transitory or not. And that comes on to an important subject for me, which is about groupthink. And groupthink is where you need more than one. So when you have a group of people who are overseeing a country or a monetary policy, and with no disrespect to economists, they cannot be all economists. You need to have a broad group of people, because otherwise you get groupthink. The model says this, that's what we do. And if you think about where inflation happened, you know, inflation in the mid-70s was 24. Then we saw inflation again in the beginning of the 80s, the beginning of the 90s, and then inflation bottomed at just above zero. I think it was 2020. So you know, this was a very difficult time, and therefore I think that also what happened then is that you had a whole generation who didn't understand inflation, and which meant that they got used to borrowing at very low rates, and so that created moral hazard. That created bubbles in asset classes. We've discussed property a lot earlier on today. It created asset bubbles, and this is what happened. And then you saw that inflation peak at 11.1%. Policy failure, moral hazard, a lot of issues that have happened since then. Since then, we've seen inflation luckily come back down to 3.2%. So I think the first thing why, you know, I would like to, you know, how we can stop free markets from inflation, which is, by the way, it's always there. You just may not see it. Inflation's always there. It's always there, and during these very aggressive periods, it jumps up. So you have that. So you have that. Inflation is always there. The second part of that is we then think about, so that's what we can do from a policy standpoint. The second part of that is where you think about what can the country do. And I think a lot of those presentations that we had earlier on today helped us on that front. So you need to have a proper policy around housing. You need to have a proper policy around how for example, the nuclear policy. You need to have a proper policy around energy. You need to have a proper policy around migration, controlled migration. Because these are the things where price paid. So you need a proper policy around that. And I think also, you need to empower the politicians to deliver on that. And you know, I'm a believer, rightly or wrongly, that the Prime Minister is the Chief Executive Officer of this country. And the Chief Executive Officer should be just that. He should be the she should be the executive. And I feel that we don't empower our politicians enough in order to deliver on that. In addition to that, we also spoke about what I call the blob, which is regulation, which is bureaucracy. this ties the hands of our politicians in order to tackle these issues which encourage prices to go up, the whole stability of the pricing mechanism. And therefore, I think that we need to take a good, hard, long look at what I call regulation, bureaucracy, things like the OBR. So that's that. And then I was going to say that I was going to say that there is a third leg to this, which is a bit of luck. And I think that we do need a bit of luck, because not everything can be put into a model. Not everything, because it's a difficult time. We have anemic growth. We have inflation that's thank goodness has come back down again, and we have a very large debt policy. And I think for us, we must never forget that inflation is always there, and that inflation is always a part of what we do, and that it needs to be managed, because when this thing rears its head, and we've seen it rear its head, this generation now understands it. When it rears its head, it is extremely painful. And I'll finish on that note.
Well, thank you very much, Charles. And maybe we can talk about the models to calculate inflation that have been used or misused by especially the ECB and many other central banks, because they did not work. But while Dr. Rahn is ready to get to the speaker's podium, I can entertain you, or may entertain you, with one anecdote that at the central bank in Austria, when we were at the General Council, when I was the vice president, one of the bankers said, we have to educate an entire new generation of bankers of how to operate in a world with interest rates. They just have not been used to that. They were all used to this unconventional monetary policy over the past more than almost 20 years. And so there's a new generation of young bankers that finally learns how to operate with interest again. So let's hope they will not forget it soon.
Do we have that video before the slides or not?
The U.S. government can't go bankrupt because we can print our own money.
It obviously begs the question, why exactly are we borrowing in a currency that we print ourselves? I'm waiting for someone to stand up and say, why do we borrow our own currency in the first place?
Like you said, they print the dollar, so why does the government even borrow?
Well, again, some of this stuff gets, some of the language that some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do? They sell bonds. Yeah, they sell bonds, right? Since they sell bonds and people buy the bonds and lend them the money. Yeah, so a lot of times, at least to my ear with MMT, the language and the concepts can be kind of unnecessarily confusing, but there is no question that the government prints money, and then it uses that money to yeah, I guess I'm just, I can't really talk, I don't get it. I don't know what they're talking about, like, because it's like the government clearly prints money, it does it all the time, and it clearly borrows, otherwise we wouldn't be having this debt and deficit conversation, so I don't think there's anything confusing there.
That gentleman is Jared Bernstein, who is President Biden's chief of the Council of Economic Advisors. And back when I was one of Reagan's and Bush's economic advisors, we had people, I hope including myself, who could explain this stuff. I have debated Bernstein. Barbara mentioned I have my PhDs from Columbia University, which I hate to admit anymore. But Bernstein has a PhD from Columbia, but his is in social work. Anyway, this is part of the problem. If you think the people in Washington do not know what they're doing, you're right. Exactly. And it's for those of us who are deeply involved with this stuff. It is so appalling what we're up against. And when you were mentioning about the inflation, I'm old enough to remember the first inflation. And I was just a young economist, part of Reagan's team. And Paul Volcker was chairman of the Fed, and he understood what the problem was. And Ronald Reagan was our last president to have a degree in economics. And actually, Reagan was a good economist. He understood. And they did the things they had to do of bringing down monetary growth. So when Reagan took office, inflation was 13.5%. We had a 21% prime. When Reagan left office, inflation was 3.5%. And we had record growth. One year we grew 7.6%. Those were heady days. And I thought, I'm coming of age when finally economists had this all worked out. And here we are, 40, 50 years later, back in the same old stuff. And I mean, let's see what you... Government debt. We look at all these countries that have debt GDP ratios of more than 100%. When Reagan left office, we had a U.S. debt GDP ratio was about 50%. We're now to 121%. Japan is at 260%. All these countries, UK, you're just a little over 100%. This is gross debt. Net debt's a little bit less. But the world's a mess. The problem is, when governments have this much debt, they have to pay interest on that debt to get people to buy the debt. And you were talking about how low interest rates would have been fine if we didn't have any debt. But when you suddenly have this great debt and interest rates go rocketing up, now each of you and your businesses, you tend to save money. That money you save, part of it goes to buy government debt. Maybe not directly, government bonds, maybe doing it indirectly. But the more of your savings that go into government debt, the less you have to go into private capital formation. That's new plant and equipment, semiconductor plants, or even McDonald's or whatever. And that depresses economic growth. And the reason world economic growth is sinking so is because so much of the capital is going off to basically buy government debt, which is funding past transfer payments. I don't want to leave you depressed, but I want to leave you with some realistic understanding of the bind we're in. And there is no easy way out. This is one of the oddest things you take a look at. And at the end of World War II, the U.S. accounted for more than 30% of world GDP. And it slowly slid down as other countries, Europe, Southeast Asia, all grew rapidly. And particularly in recent years, China's share of world GDP increased. 4 or 5 years ago, there was all these articles, when is China going to overtake the U.S.? What odd things happen? The U.S. share of world GDP is increasing, and China's backed off some. Europe is slowly continues to drift down. Japan is going nowhere, it's drifted steady down. India is coming up, but they're too small. But this looks great for the U.S. It's actually very bad news. Let's say you have a little rice miller in Nigeria. He's got a little business. He makes a little extra money. He puts it in a local Nigerian bank. That bank maybe have a corresponding banking relationship with HSBC, one of the big banks, who has an account with the U.S. Fed, and they buy U.S. government bonds. So what you have is savings from poor people in poor countries going to support the lifestyles of rich people in rich countries. This is totally backwards. For years, well, as an American, I'm well aware that the British built our railroads. In the last century, huge amounts of savings from the British people and British businesses went to the US, Canada, Australia, and so forth, and built our railroads. That was good. You had capital formation going to the less developed countries from the most developed countries. It was Britain. Now this thing is reversed. I spent half my year in Miami. Miami is a great boom city of the world now. We're building 100-story buildings. Our skyline is now the 3rd highest in the United States. Florida, the whole state, is just an absolute boom. I grew up in Florida. I'm apprentice towards Florida. We have no state income taxes in Florida. Very good delivery of services. And as the governor of New York said, her tax base has gone from New York to Palm Beach. And it's true.
Too bad for him.
But also, Latin America particularly fuels Miami. All the savings from middle income, poor people in Latin America goes into Miami and builds all these beautiful buildings. And Miami is a glorious town now. And me and all the other people who live in Miami, this is wonderful for us. But where's it coming from? Not good. Just to give you a thing about private debt's also growing very rapidly. You see the big growth in public debt, but this is debt. We don't have enough time for me to go through all these in detail.
We can do that Q&A.
Okay. But the this is how the U.S. debt is held. The Federal Reserve is buying much of the debt, and it gets back to Jared Bernstein thing. Oh, we're printing our own money? Yeah, I can give a long couple-hour lecture on how this happens, and by the end you'll want to get sick because it is. I've just watched this grow over the years. This jerry-built system. We no longer have, as you know, federal open market operations or anything anymore. This is just look at the growth in the Federal Reserve. That's all printed money at the end, that big jump. Okay, holdings of U.S. government debt. Who holds it? Well, China is the biggest holder, about $1 trillion. Japan, I think they're about 800 billion. They said big numbers for UK, Ireland, Switzerland. Those aren't real numbers. That's the money coming in through the City of London. As Barbara mentioned, I used to be on the board of the Cayman Island Monetary Authority. And in Cayman, we have maybe $3 trillion that comes through there. They hold $300 billion of debt. You know, the 60,000 people who live in Cayman don't have that money. That comes from the rest of the world, and I can give, again, a several-hour lecture on how we manage that, keeping the game honest and also free. But so these numbers, you read these official numbers, this doesn't account for all the people around the world who funnel the money through the tax-efficient jurisdictions. She yells at me if I go over time, so
Yes, I will. I'm almost yelling.
yeah. So I'm trying to go through. Interest rising. I mean, this can't happen. Finally, what you're doing, your whole government budgets, the U.S., the UK, everything would go to interest. There'd be nothing for welfare benefits, for defense, national health insurance, all the rest of it, and all the fundamental functions of the government. And she's yelling at me, but my initial video, that was entertainment, so that shouldn't count. Okay. Federal debt held by the public, but you see the problem, and it's Okay, this is the one thing I got known for in economic textbooks, looking at the optimum size of government, and it's in some of the textbooks because years ago in the 1980s, I was trying to see what the relationship was between economic growth and the size of government, and we determined virtually every government in the world was above the optimum. And economic freedom is correlated highly with real per capita incomes. Growth is good for making people wealthier. It's also good for making us free. And I guess I have to stop here
Before I'm getting up.
Yeah. Also, life expectancy. You live longer if the country is rich and free, but you knew that. Thank you all.
Thank you very much, Richard. Not only for entertaining us at the beginning, but also for providing us with those negative outlooks and those sad projections. So we hope we can change something. But Sir John, the floor is yours now, at least for the next 10 minutes. And then we will have a discussion on that. Thank you.
Gordon Brown, previous Labour Chancellor and Prime Minister, told us that he made the Bank of England independent. That was largely spin. It is true that he reinforced the independence of the Bank of England to sit around the Monetary Policy Committee table and to issue truly independent forecasts based on its own model making and economic wizardry. And it is also true that he confirmed the very significant and important power to the bank that they would in future have sole charge of determining the leading short rate of interest in our market, the base rate. They'd always largely done that, but it was true that they consulted Chancellor and Prime Minister sometimes for conversations, and that was dropped. But what he didn't stress was that in other ways he gutted and filleted the Bank of England. For example, he took away its very considerable powers to regulate individual large commercial banks, crucial power for a central bank to know what the credit-creating commercial banks are doing, but that was hived off and given to another independent regulator. And when the big banking crash occurred in its British version, the rows between the two so-called independent regulators were part of the reason why it was particularly difficult to reach a solution. And he also took away the powers, quite considerable powers, the bank had to regulate and to control the issue of public debt in the markets. Again, a very crucial power for a central bank, as dealing in high-quality government paper is a very important part of regulating interest rates in markets. And he gave that to an adjunct to the Treasury, the Debt Management Office. I and others who are critical of the Bank of England have never said that we wish to take away from the Bank of England its independent power to settle the base rate. What I and other critics have said is that they should get a lot better at using their independence to construct a model of the economy which has a reasonable chance of forecasting inflation accurately. And then they can use that, as they wish to do, to inform their discussions to set the leading base rate accordingly so that money growth is neither too hot or too cold, so that the economy responds. The Bank of England's model clearly doesn't work. They were forecasting 2% inflation for the period when it hit 11% 2 years ahead of the event. And I'm grateful to former Governor Bank of England and now to Ben Bernanke, who was sent in from the United States to investigate the poor record of the Bank of England, for pointing out, one directly and the other indirectly, one of the reasons why the Bank of England found it so difficult to get its inflation forecast right was that its model gave particularly strong weighting to the longer-term expectations of inflation. And the bank reasoned that because they were intending to keep inflation to a 2% target, it was very likely expectations for 2 years out would clearly be at 2%, and so it was a self-validating forecast, so that they could quite happily, regularly show 2% as the inflation rate 2 years out, whatever the economic and monetary reality. So how should they go about fixing themselves? Well, I've made several recommendations to improve their performance. They themselves have admitted that their forecasting has been very bad, and their Bernanke review confirms that it's not only bad, but it's got progressively worse. The last few years have been particularly bad. And their rationale for this is to tell us that they couldn't have been expected to have foreseen external events, and so they did not foresee pandemic lockdowns, and above all, they did not foresee the Ukraine war, and they claim that 90% of the overrun of inflation was brought about by two external events over which they had no control. It still leaves open the question, well, if you can't actually forecast any of the things that really affect inflation, what is the point of the exercise? But be that as it may, I don't even believe that explanation. Because, of course, they originally said that it was the Ukraine war and the energy prices that came along that upset their inflation record. Whereas if you look at the graph, you will see that the UK rate of inflation had hit 3 times target, around 6%, before Putin finally moved his troops into Ukraine. So you can't just blame the energy and Ukraine market. And as to blaming pandemic and COVID, there were obviously very strong deflationary forces at work over COVID in terms of activity, which you'd have thought might have been also important. Their compass model, which is still their base model, although they now say they have other models as well, and what sort of model would you like, but their compass model also seems to be based upon aggregate demand, and it really believes that the main likely cause of changes in inflation is where the demand is excessive or has fallen, and they often take as a proxy for that the rate of unemployment. Now this again is a very odd thing to build into your model of the UK economy, because if, for example, we do have low level of unemployment, difficulty in recruiting labour, we import more. We import the goods. We also now seem to import quite a lot of the labour. And so they really do need a more international model. But above all, I think their model needs to encompass money and credit. And all the evidence is that the limited number of forecasters with models, and the odd forecaster like myself with no model, but just making judgments, who said if you print that much money, you're likely to get an inflation, turned out once again to be right, although we were told we didn't really understand it and that wasn't very scientific. I can't help feeling that money variables taking a stronger role in their model would be very helpful. Indeed, I found a 1979 paper from the Bank of England, discussion paper 3, when I was reading a few things ahead of this talk, which said then, why don't we create an alternative model which takes money more seriously? I also note that Ben Broadbank, in his defence of the Bank of England in this latest long speech, has said that the proof that we mustn't have politicians involved in the interest rates is the 1970s. Because during the 1970s, the UK record on inflation was clearly considerably worse than the German Bundesbank record. What he doesn't point out is there were also some other differences, apart from possible degrees and forms of political intervention, most namely that the Bundesbank had an impeccable inflation record until the Ostmark-Deutschmark disaster, because it followed monetary variables and it set a monetary target. And when the ERM was set up and proved to be an inevitable disaster for the UK and Italy and others, instead of us copying the monetary target of the German authorities, which would probably work quite well, we tried to keep our currency in line with their currency in very volatile currency markets, and did the opposite. We debauched our money supply, both first of all creating a massive excess of money, because the pound wanted to go up and we had to create it to sell it, and then creating an enormous shortage of money because the pound wanted to go down and we had to destroy the money to try and get the value of the pound up. So the bank should really have learned from putting us through that dreadful exchange rate mechanism situation that money matters. Briefly on the other, in a way, much bigger issue, and that is the flexing of the Bank of England and other central bank balance sheets. And I have been extremely critical of the excess increase in money and credit in order to buy bonds in the recovery phase. The last 150 billion was clearly over the top. They did 895 billion between the original banking crisis of 2009 and then the COVID crisis of 2020-21. And that was bound to debauch the amount of money in circulation. We and the Fed even more so greatly increased the money supply. And surprise, surprise, we get an inflation. Now I'm extremely critical of the reverse process, where the Bank of England is an outrider in austerity by deciding that it wishes to sell a lot of the long bonds on which it has lost spectacularly large sums of money before they dare to shorten and go up in value again, to maximise the losses, because the Bank of England, unlike the Fed, has a complete guarantee from the Treasury, therefore the UK taxpayer. And we have already, we taxpayers in Britain, had to send the Bank of England £49 billion to meet its dealing losses and other losses on bonds to date. And we may have to send them another 40 billion this year on some of the forecasts. This is a disgrace. And so what we have in this country is not a position where the politicians are meddling with the monetary policy. We have a position where the Bank of England has taken over the fiscal policy. And no wonder there isn't any money for the health service or tax cuts if the Bank of England has decided to lose tens of billions of pounds every year. And that is the current position. The OBR says the losses are going to rack up to about 179 billion over the 5-year forecast period. The bank should be told to control the losses, stop selling the bonds in the market, and learn how to run a bond portfolio. I don't want them competing to get the prize for being the worst bond portfolio managers in the world.
Barbara.
Thank you, Sir John. We could have listened to you much longer.
Barbara, I have
John.
a one-sentence addition to Sir
Yes.
John. In case you're feeling bad about the Bank of England, the Fed has been equally, if not worse. Powell, our chairman, and Janet Yellen, our Secretary of the Treasury, seemed totally surprised and shocked when inflation went up, in our case, 9%. But they'd increased the money supply by 43%. Yeah. What did they think was going to happen?
Well, this is a surprise probably to many, and I just have there was an interview by the former Fed Governor Heller in the Wall Street Journal, where he mentioned officially, the Fed needs to change but stay independent. It continues, even worse. And he also admitted at the same time that the Federal Open Market Committee has fallen short in the past years by not focusing on the monetary and credit aggregates. Come on, I mean, it's their job to do that. So what is your take? How can we fix this? Because I would say in Europe, we need to cut the telephone line between Frankfurt and Brussels. So no interference between fiscal and monetary policy anymore.
Well,
Richard, the question goes to you right away.
the absurdity of central banks losing money, the Fed never lost money until the last 2 years. To be a central banker and lose money, that takes a useful degree of skill.
Well,
I mean, that's really hard to do.
But doesn't this have two different reasons? One, they cannot run the treasuries as they should do, obviously, as you mentioned out, Sir John.
Well, no, the problem is a big argument over whether money and credit matters and whether it has an impact on inflation. And a big argument over whether anyway it makes sense to deliberately create money to depress the interest rates on bonds so much that you distort the whole fiscal position. And we've seen some very dramatic pictures on the colossal build-up of US debt with the current administration running a very large budget deficit despite the fact that America is growing relatively well compared with the rest of the world and has put in a pretty good economic performance apart from inflation.
Maybe I give one simple explanation. If you
let me have Charles first, then Sir John, and then Richard. Please continue, Sir John.
Yeah. No, the argument is over. Is there some better way of controlling inflation? There clearly has to be. And why don't they produce the money-based model and backtest it? Why didn't their backtests on their current model show that it wouldn't work in these more extreme conditions as they see it? And on the bond losses, there are three ways in which both the Fed and the Bank of England are or can lose money. The Bank of England's trying all three. There's first of all selling long bonds in the market, which may be at half the value they paid for them or less because interest rates have moved so much. A lot of these central bankers, I don't think, understand the huge volatility of long bonds and how if you double the interest rate on a irredeemable bond, the price will halve. So you've got these very large losses the bank is deliberately incurring. You've then got the losses on the bonds that fall due for repayment, because most of these central banks paid more than the repayment value of the bonds to buy them. That was their whole idea. They wanted to drive the price through the roof. So they were paying $110, $120 for a $100 bond. So they make the losses when they fall due for repayment. And they now are managing to credit themselves with a massive running loss because they say they are financing the bonds with the reserves that the commercial banks deposit at the Fed or the Bank of England. And so the Fed and the Bank of England are paying the commercial banks the full newly enhanced short rate in order to finance a portfolio that pays a fraction of that because they deliberately bought bonds yielding very little money. The ECB is much better at controlling the losses. It refuses to sell any bonds in the market. And it is not paying the full amount on reserves. It pays 0 on minimum reserves, and it pays a deposit rate on the balance. And it's interesting, the Bank of England paid nothing on commercial bank reserves before 2006. So it's an entirely voluntary tax on itself, which it then sends on to the taxpayers.
Charles?
Yeah, just to add to that. So I spoke about two things. The first one was about monetary policy, and the second one was about what we can do as a country. On the first one around monetary policy, you know, I would like to see central banks globally stop being financial superheroes. Is that they cannot bail out, you know, even though it's a very noble and a very honourable cause, they cannot bail out everything the whole time. You know, there has to be winners and there has to be losers. And I caveat by saying that, you know, every responsible country wants to have a social network, but there needs to be winners and there needs to be losers. And I think the reason we got ourselves into such a bad mess, is because we had this roller coaster, this violent swing in interest rates. And as a reminder, our interest rates went from 10 basis points to 5.25. Yeah. I mean, that is an absolute roller coaster. And so therefore, what I would like to see is I would like to see a gentler hand on the central bank, but with the central banks on their interest rate policy, because it has not served the majority well.
Richard, sorry for cutting you off.
Well, the central banks are trying to engage in fiscal policy, and they can't. If you have, like in the U.S., a third of our federal government spending is now debt. As you point out, we're supposed to be in recovery. Any of you who believed in Keynes, we're supposed to pay it back during this time, let alone coming from a monetary standpoint. When these central banks lose money, now there's not a bank to bail out central banks. Okay, how does that loss in money show up? You can ponder that. John and I know.
Before I open it to the floor, one provocative question. Will Millet fix it? To all of you, from different angles and perspectives.
Let's hope. Go ahead.
Well, I think Millet is quite right to say that he had to get the budget deficit down quickly, and he was quite right that he needs to introduce monetary discipline. I wish him well with that, but of course without a parliamentary majority and with the obvious political pressures there will be, it will not be easy for him.
Anything to add, Charles, on that?
Nothing to add.
Richard?
No? We wish him well, whether he can pull this out with his own population. He makes sense. The rest of the population hasn't made sense.
Well, we'll see. The floor is open. The gentleman in the back, or it's Tom. Yes. First question, and then the lady in the front.
Two questions, actually.
Yeah.
Could you briefly touch on the independence of the Bank of England and when a central government takes over controlling inflation as a government objective when actually that's the Bank of England's objective? Has that really muddled the confusion between the two? Do we no longer have an independent Bank of England in this country?
I guess the question goes to Sir John.
Well, it still has the Brown settlement that I described. The bank is completely independent on short-term interest rates and monetary and economic forecasts, and the MPC does the same role as it did before. Rishi Sunak doesn't intervene in that whatsoever.
The lady here.
Thank you. Claire Cummings from the Centre for Digital Assets and Democracy. So, John, I wonder if you could help me with a conundrum that is my personal thinking. We here are the electorate. You are elected. One of the few sort of powerful rights we have is to vote for people. And yet we seem to have taxation without representation when it comes to anything financial. I understand that obviously those we elect cannot be in charge of all regulation. They can't run the FCA. But there seems to have been a handover of power from those who we elect to the unelected to do whatever they want. And not only are they unelected, but also I doubt any of them has ever actually sat or even seen a trading desk or a trading floor. So my conundrum is, where do we put the balance between what you, the MPs, do and those whom you appoint in ever increasingly powerful and unaccountable quangos?
Well, these bodies should be accountable, and constitutionally they can be accountable. But it is always a matter of judgment for any executive government minister whether the problem is sufficiently worrying or important that the government needs to intervene, or whether you just accept that it's the rough and tumble of regulating that area and it's best left to the independent regulator. But in the end, if the public tires of the results of an independent regulator, the politicians either get rid of that regulator or the electorate get rid of the politicians. It's as simple as that. And I think you're asking a fundamental question of great importance, which I've been writing and thinking quite a lot about, which is how many independent bodies do we need? How independent should they be? And how do they carry out their duty to be accountable to Parliament and to the government? Because the Bank of England itself, this very strong independent power, is still accountable. It has to report to the Treasury and Civil Service Select Committee. The governor has to attend a session if they wish to interview him, and he has to make the case of what he's doing. If more people or more MPs thought it was out of control, it would be a subject of parliamentary debate. And the Bank of England knows this. They have to be operating in a democratic society. But politicians are very reluctant to intervene because they want the independent idea to work, obviously.
Well, thank you. And my last question goes to Charles, because it's a simple yes or no question. You having been in or being in the financial sector and in the industry for such a long time, can we save the industry and free markets if we simply cut the red tape and the compliance and all this over-regulation?
It's actually an unfair question. It's not a yes or no, because I'm a believer in regulation. But I'm also a believer in a credible growth strategy that will throw off the shackles of managed decline, which is what we're experiencing now.
Well, that explains it. Thank you very much.